learn. So please help me welcome Don Crozier here to the stage.
We got it? There we go. Okay. Sometimes you have to be smarter than your equipment. So, thank you very much for the introduction there. And hopefully, as she had said, it's about a 4-hour course that I used to do for continuing education, trying to condense it into 20 minutes, maybe even less, so I can have some question and answer period at the end. So I'm actually going to start my little timer here because sometimes I tend to want to wax strong philosophically on lots of different things and get off the topic subject, so we're going to try to do that. Now I have a couple of things at the end that is a little brochure that I put out that has a lot of the things that I'm going to talk about here in a little more detail that I didn't bring a whole bunch, but for those that might want to get that, and certainly if you give me your email address, those kind of things, I can email you a copy of this also online if you want to do that also. So just have that available there. And because you might want to take some notepads. I see that some people have some notepads right there. Hopefully, I'm going to give you some information that in the credit world is, I would just say right off the bat, is very counterintuitive in a lot of ways. Things that you think are going to help you will actually damage your credit score. Now, if you're not trying to get any kind of credit, so sometimes things that you do, it's really not that big of a deal. We don't need to freak out about it. We know some people get overly zealous about what they're doing with their credit. But if you're not trying to get some sort of credit, then it doesn't really matter because your credit score is really a number that tells the whoever your creditor is going to be the likelihood compared to others as to your ability to repay that debt, and more importantly, specifically, is what is the likelihood compared to 10 million other people that you would have a 90-day default on your, or greater in your, any of your, in my case, would be mortgage-related industry, so in your mortgage payment. So what's the likelihood of that happening? That's really what the score model is trying to determine. So there's several factors that go into it, and I wrote a couple of little notes here because, like I said, I'm trying to condense about a 4-hour conversation into about 20 minutes. So let me just go through this real quickly if I can, and so that I can not get off topic. One of the key things is that there are 3 bureaus out there that your credit is reported to. Not all creditors report to all 3 bureaus. There's TransUnion, there's Equifax, and then there's Experian. And some of them only report to 2 of them, some report to 1, and some report to all 3. So that's why in the mortgage business specifically, they will pull all 3 bureaus because all 3 bureaus may have different information on you, and you might have a 800 FICO score on one, a 740 on another, and a 620 on another. The 620 on another probably is the one that you had 3 or 4 collection accounts on that. They only reported to that particular bureau, therefore that's what's going to be reported there. And one other thing that's really clear, a lot of people ask, I'm trying to answer as many questions that I know come up on a regular basis, is that husband and wife, if you're married and you have joint accounts, you would assume that you're going to have the same exact score. No, it doesn't really happen that way because we never always have exactly the same score, and we got into the relationship with the history previous to our relationship. So therefore, one of the key factors in your score and how a negative derogatory account or even bringing on new credit is going to affect your score, either positive or negative, is where you start. What was in your history? One good example is if you are a person that had some sort of a bankruptcy in your past, it could have been 20 years ago, anything that you do on a negative basis now in your score will dramatically drop your score faster and more deeply than somebody that has never had a bankruptcy or short sale or any of those kind of things. So your history is really a lot to do with it, because a lot of people say, well, how come my wife, it always seems that the wife has the 800 score and the husband has the 740 score. I don't know. They lived together 20 years, it always seems like that's still the case. But we'll let it go at that. But a lot of it has to do with the type of credit that each individual has. A lot of times the wife will have a Macy's card, and husband is not interested in a Macy's card, so on and so forth, those kind of things. So let me get back to some of the key elements here. So we've got the range of scores is 300 to 850. Almost nobody has an 850. And it really doesn't have anything to do with how much money you make. In my travels, I've seen, as a matter of fact, most of the people, the doctors, lawyers, those kind of people, they are at PhD level in what they do. They have no clue to finances, unfortunately. So they do things, and somewhat, I should probably take out those particular professions in general, but it just is that people tend to sometimes think that I'm making so much money, I have so much assets, I'm worth so much value here. If I don't make this payment on time this month, it's no big deal. They already know I've got $1 million in the Charles Schwab account. No, what we're talking about is on paper, in the system. It doesn't matter what you think, who you are, or what you're about. It's about what can you prove on paper. So that's the key thing there. The odds, in fact, this is why it's important here, give you a little example, is that if somebody has a below 600 FICO score, that person is 1 out of 8 people will default on their loan. 1 out of 8. Whereas if they have a 800 or above score, it's 1 out of about 1,290 people. Kind of different odds. And most people are in the 720 to 740. If it's in but if we're in a 760 to 799, not quite 800, that's 1 out of 597. So there's still a dramatic big difference between the next grade down. Now, as far as the scoring is concerned, the challenge comes into that there are, with the new laws within the mortgage business, that if you get below a certain score level, there's no way that you're going to get any kind of financing whatsoever to cut you off completely. So here's one of the things that, if you're, let's say for example, you're at a 765 score, and then you go out shopping, holiday season, and you go into Target, and they say, if you get a credit card with us right now, we'll give you 10% discount on your purchases today. And then, ongoing, that you think, okay, 10% discount on this $200, I'm gonna buy this, $20. That's a great savings. I'm gonna do that because I never have to use the card anyway. So I just have to have the card, or I'll just pan it, whatever, down the road, but I'm getting my free 10%. Well, let me tell you how that might not be exactly the wise thing to do, because immediately upon them pulling your credit to authorize you getting that credit card, it is going to have a negative effect on your score. So it could be as much as 3 to 5, maybe 8 points. So if you're at a 65 score, 765, and that was a price point, as we would call it in the mortgage business, and you go below the 760, let's say 759, because of this inquiry, that might cost you a 1/4 point in fee on your refinance, if that's what you're trying to do right now. Now, like I said earlier, if you're not trying to do any financing, whatever, then go for the 10% discount, that's fine. Because it's only going to take about 6 months for that to be eradicated and be back to where you were before. It just comes naturally back up. But the point is that the creditors, the bureaus, recognize that if you're getting more credit, they don't want it to be the last credit you could ever get, and they're holding back. So that's another reason for the diminishing score piece right there. So what happens is, and I'll get back to this story in a minute as far as the shopping event and getting the credit card, because there's more to it than just that. If it was that simple, we'd be end of discussion, but it's really not. So here's a couple of the factors that come into play in the modeling, and there's 40 different factors that actually they track, and this is on a global scale. And so it's not any one thing. A lot of people say, well, how come, again, why is my score this way? How come my score didn't come up when this happened? Because it takes into account 40 different key elements within each individual file. So if you've got an algorithm for that, it's fairly odds on that you're going to have some sort of different effect with you and your wife. Now, what it doesn't do, by the way, it does not take into, against the myth, it doesn't take into account how much money you make. It doesn't take into account your race, color, sex, creed, religion, or any other issue that would be a prejudicial type of a situation. And it does not take into how long you've lived in your house. So if you're renting, you're owning, those kind of things, it does not take that into account. Okay? So, well, in an off sense, if you're owning or renting, it does take that into account because you're not going to have a mortgage on a rent. So therefore, it would be a less of a value point there. So the go through this. Okay, so the key, there's 5 areas that are key that they will be weighted in your score. So remember, we've got 40 different factors, differential factors that come into play, but they're in 5 areas. And here's how it's weighted. You might want to write this down here. 35% of your score model is based upon your past payment history. Were you late, were you on time, those kinds of things. Now, one of the things is a hint, if you got a mortgage and you have, let's say you go past the 15th of the month, you're going to have a 5% penalty for late payment. That is not reported as a derogatory on your credit report for those purposes. Your payment has to be 30 days or more late in order for it to be a negative claim there. You may have to pay the penalty, and your company might send you nasty letters, those kind of things, but it has nothing to do with what's going to be reported on your credit report. Okay? So the other thing is that 30% of the weighted score is based upon outstanding debt utilization. So the key point there is they want you to have, if you want to have a perfect score, is get best or perfect score, have about 4 revolving trade accounts. To tell you the truth, in the mortgage business, your revolving credit history is probably more important than just about any other aspect in there, because that can have the biggest effect on your score. So, for example, if you have 4 accounts and you have, but you like one because it gives you all sorts of benefits with the travel points, those kinds of things. So you dump everything on there, let's say it's $10,000 on that card, and you have that $10,000 maxed out, and you have 0 on your other 4 cards. You will have a much less and greater reduction to your score because it's now, as they would see it, you've got a 100% debt-to-income ratio on that card. And they do not average it out and say, okay, you've got 20,000, let's say each card had 10,000. They're not going to average it out and say you had 40,000 potential credit limit on your cards. You have 10,000 only, so that's only 25% debt. Therefore, you're golden, because 25 to 33% is really what you want to have in there as far as your balance to limit ratio on your credit cards. However, if it's all on one, it just sees it as just that 100% debt drops your score. But once again, if you then spread that and do balance transfers or whatever you ever need to do and have that full 10,000 spread amongst all 4 cards, you will then have an awesome credit score, and it will be instantaneous as soon as that information hits there, because remember, your score is just a snapshot of that moment that the credit report is pulled. Okay? So that's the other factor there. The history of your credit, how long. So the other factor that comes into play is that we all start out generally in college or sometime around that point there, we start getting some sort of credit card. Maybe we'll buy a car, or maybe do something along those lines. And so the longer that you're in the system, the better it is for you. So one of the bad things about it is sometimes we get a bunch of cards, and then a great card comes along with 0 interest, 0 fees for 12 months, introductory offer, blah, blah. And so we cut off 3 other cards that are really high interest rates we've had for a long time. We cut those off because now we have this great card over here, maybe one other one that we keep. Well, in doing that, you immediately take the aggregate of your length, because they aggregate the time in there. Now all of a sudden, your aggregate time in system is much shortened because you just cut off the ones you had for 20 years. Okay, so here again, it's counterintuitive to what you would think. They only want me to have a few and scores, but when you do something that you think is going to help you out, sometimes it can actually hurt you in that there. The other thing is the type of credit. So you want to stay kind of away from finance company type things. So they want you to have the Visa, MasterCard, the regular revolving credit. They want you to have a mortgage. They want you to have an installment debt, such as maybe a signature loan, could be a student loan, could be a car payment, those kind of things. They want to see the mix that you're able to handle, and you use credit, but you're a good credit user. You're not maxing everything out, and you can do some standard every month. I pay this amount. Other types, I'm paying a different amount. Maybe I'm paying off, maybe I'm not. They want to see that there's a good balance of those kinds of things in there. So that's really what you're gunning for. Get an auto loan, a credit card, about 4 of them at the max, and then now the negative side is when you do get your department store type cards, because they're generally not a revolving card in that same sense. And also, if you go to a finance company, that would be, there used to be a TransUnion and TRW, and there was different companies that were known to be, if you went and got, or for example, you go to Best Buy and you get their same as cash plan and those kind of things, those are done by non-financial institutions that would be recognized as your regular revolving account. So that becomes a negative stigma on there, because you did that because, in their mind anyways, it was because you really couldn't get financing some other way that was going to be a better rate. So why would you go with something that's going to be more in the end than had you had the ability to get something that was of good value? So that's kind of the thought on that. We don't have to agree with them or disagree. I'm just telling you what it is. And the last thing I already talked about was the inquiries. So that is weighted at 10%. So by the way, the type of credit that you have is actually weighted at 10% of your score. The history is 15% of your score, and the inquiries is also 10%. So one of the other things that's...
By inquiry, you mean someone checking your credit because you're
yes.
credit?
Okay, correct. So if somebody checks your credit, but if it's for only their marketing purposes, remember you get prepaid, or excuse me, not prepaid, but pre-approved, thank you. Pre-approved letters in the mail that you're pre-approved. Well, I can tell you right now that's not true. Okay, they're just phishing, right? But they did do some marketing thing to get you kind of, okay, this person probably will be pre-approved, okay? But I guarantee it's not a guarantee. But those kind of things do not affect your score, so don't worry about that. But if you then respond to that company and say, yeah, let's see if I can get a card, now they're going to pull the actual one that will be an inquiry that will affect your score. Okay? So that is definitely the case there. So anytime you pull, now one of the other things, if you're looking at mortgages, don't let a mortgage broker or a loan officer tell you that you can't go looking somewhere else for a loan and shop it because your score will drop. Because the fact of the matter is, if it's a industry related, so if it's another mortgage, if you went to 10 different mortgage companies in over a month period of time, it would count as one derogatory as far as the inquiry part, because they realized that people had the right to shop for the best deal. And so, and each company does have to have their own credit report. They can't go off of what you had before. The other factor is, then you want to write this down, if you want a free annual credit report that has more information than I can even get as a mortgage broker, that you would have, you can just go to www.annualcreditreport.com. Now, there's all sorts of commercials on TV for free credit report. They have, all those kind of, they're really fancy. They're catchy tunes. I mean, I like them. But those are really third-party marketeers that are going to then try to get you to do something else. The annualcreditreport.com is an actual government site. They're not going to try to market you and those kinds of things. Now, you cannot get your FICO score for free. So the credit report is free. But if you want the score, the FICO score, then you have to pay, it's usually $5 to $7 per bureau. So there's 3 bureaus you get. Now, I will also advise you that the score that they will give you on there is not going to be the same as if you pull a credit report that I pull for you as you're trying to get a loan, for a mortgage loan. Because what we have is industry-specific report and score modeling which is different than the general score modeling they would have for just any kind of form there. So I've just had a recent situation like that when the person came to me and said, hey, I got my score up based upon what I had told him he needs to do. He says, I did all those things, I got my score up, and I pulled my score from the